Monday, July 18th, 2016. Monaco 64 here, home of alternative economics and contrarian views. I like to talk about the bond market today, and specifically the U.S. Treasury market, mainly because the dollar has been the reserve currency since after the war, 1945, Second World War. So treasuries are the benchmark for global yields or interest rates. And to clarify the treasury market, any treasury with maturity up to 1 year is called a bill. After 1 year, we go up to 2 years, and that's called a note. A 5-year treasury is also a note, and a 10-year treasury is a note. After that, it becomes a bond. So the 30-year bond is a bond. It's not a note. So I'm going to be focusing on the interest rate cycle based on the U.S. bond market, and I will focus on the 10-year treasury note yield, which is basically the interest rate on the 10-year note. And let's start out with the last, not last, but let's start out with the 1940s, where we had World War II. And it did start in 1939, but the U.S. only got involved after December 7th, 1941. And as you can see here by this chart, the 10-year note yield was just below 2% around the end of 1941, and then it just spiked all the way up to almost 2.5% in a matter of, well, just a month or so. So that looks like that was after the Pearl Harbor attack by the Japanese. 10-year note yields spiked. Then the U.S. entered the war, and it looks like yields were kept at around the 2.4, 2.5% yield. It looks like the Federal Reserve went in there and kept rates. You know, they manipulated it. It was a wartime, situation, so I guess they had the excuse. And then, as you can see, as the war draws to an end, 1945, 1946, the 10-year yield drops back towards 2%. I would say it drops just to around 2.10. It makes a bottom there in 1946. The war is over, and so I'm going to take 1946 as a low there for the 10-year yield, low for the cycle, because the war has ended, right? And then, the low is around 2.1% in 1946. So looking now longer term, I'll take a look at the 10-year note going up, from 1946 until 1981. And as you can see, the bottom was 1946 there after the war at 210, and then we've had ups and downs. Yields pretty much went up from 1946 to just after 1953, as you can see, and then they dropped. Then they went up again. There's a drop before around 1958 there, but it didn't make a lower low. And then we made a higher high in around 1960. That was almost up to 5%. Then we dropped again, and then we made a higher high in, around 1970, 71. It looks like we went up to 8%. And then we dropped back below 6%. And then we went up again. And then through 1974, 76, we made another high above 8%, and then dropped again to around 7%. And then there was a major leg up into the early 80s. In 1981, the high was around 15.8%. So that was from 1946 to 1981, which is 35 years roughly. So that was a bear market in the bond market, or in the 10-year Treasury note, and yields went up. The price of the bonds went down, of course. So if you'd bought if you kept buying 10-year Treasuries, from 1946, by 1980, you wouldn't have protected your capital because the prices would have gone down if you'd reinvested it. So now we move to the period from 1981. That was also when Paul Volcker let the short-term rates go up to almost 20%, mainly because investors lost confidence in the U.S. Treasury market, and that's why bond the 10-year note yield went up to almost 16%, and the fact that Paul Volcker let Fed funds rate go up to 20% killed the bear market in treasuries or in bonds. So that 15.8% marks the high bond yield, 10-year yield. And then, as you can see, we've had basically 35 years again, from 1981 to present day, 2016. As you can see in the chart, we've had lower lows and lower highs in the bond yields, all the way up to this month in July, where we hit 1.36, and I think the previous low was sometime around 2012 or 11. I'm not sure, but I think it got to around 166. So we got to 136, as you can see, in 2016, and now I'll look at a short-term chart of this year in the 10-year Treasury yield, and as you can see now, we bottomed at that 136, just around the non-farm payroll number. That was 136, and now we're almost back up to 160. So yes, basically we've had a 35-year bull market in the bond prices, government bond prices, U.S. Treasuries, and yields have been going down for 35 years, and that's allowed the bull market also in financial assets, because all financial assets are priced off the U.S. Treasury interest rates, because U.S. Treasury interest rates are supposed to be the risk-free return. So all the calculations for equities, even commodities, currencies, corporate bonds are all based off the U.S. Treasury rates or yields. So what's gonna trigger a start of a bear market in treasuries? I don't know, but we might have hit the low there at 136 in the yield. We might be just starting a bear market in the bonds. As you can see, these cycles are quite long, 35 years and another 35 years. So I'm not saying we're going to go back up to 15% by next year, because that would be, a huge spike. And that what we might see, is ratcheting up of interest rates. We could maybe go up to 2.5% in the next year or something like that, and then drop back to 2, and then go, after that go up to 3, and keep making, higher highs and higher lows in Treasury yields. So I've had people asking me, oh, do you think we're going to see the Fed raise interest rates? Well, the thing is, it all depends on the market and the longer term rates. Right now, the Fed uses something called forward guidance, where they can tell the market that they're going to keep the Fed funds rate low for a long period, so that calms the bond investors, and they, it helps keep yields low. But how long is the Fed going to be able to do that? What's the credibility of the Fed looking like? We've had 8 years of this zero rate interest rates. Beginning of every year, people keep saying, oh, the Fed's going to start raising rates, and they never do. So the other thing that could happen, this 35-year cycle could end, and we could actually see a huge spike. It wouldn't go up to 15.8, but we could still see a relatively big spike in terms of percentage. We could go from 1.36 to 3. That would be a huge spike. But, we'd still be in the new 35-year cycle. So yeah, the Fed can control the short-term Fed funds rate or the repo rate that they're looking at now, and they can use forward guidance. But once they lose credibility and the bond market turns, they can't do anything about it. Look at Paul Volcker. The Treasury rates forced him to allow the short-term rates to go up, and that was a good thing he did. And so. Yeah, it could be that we're very close to, being at a bottom in yields and a top in bond prices. So, if you're going to be borrowing money, probably think about doing it for long term because you might never see, these kind of low yields for the next 35 years. So if you enjoy my analysis, please like, share, and subscribe to my channel, and I'll talk to you later. Take care. Bye.